Radio.
And we're back with my radio show, my favorite hour of the week. It's your host, Dawood Bedrosian. You know what show you've tuned into. It's RealSense Now. We've designed the show to give you all the facts that you need to know about our economy, the real estate market, what are the trends going on, whether you're a buyer or a seller, some ways to find some lucrative investments, and really kind of give you a pulse on what's going on. We're here, more importantly, to really show you how owning real estate is really the cheat code to your success, plus a whole lot more. So if you're tuning in for the first time, we're live every Saturday at 11 a.m. with an hour-long show where we cover all things real estate. I'm joined today by my good friend, Mr. John Papaloni, real estate investor, real estate advisor, fellow podcaster, and just all-around real estate maven. John, thanks for being a part of my show and coming all the way up here as well, too.
Oh, thanks for having me. I'm absolutely excited and stoked for this.
And first time in Orlando, right?
First time in Orlando.
And what do you think?
Loving it, man. I'm like, it's gonna be. I'm gonna be crying on Tuesday night when I go back for Wednesday.
Oh, I can imagine. I can imagine. Talking about traveling, I just flew back in from a 12-day stint in Canada, where we actually hosted a 700 in-person event talking about buying Florida properties. I mean, they had a team of experts there from all over the place that covered everything from different parts of Florida, the Orlando market represented by myself, of course, the South Florida market, the West Coast market, which is Naples, Fort Lauderdale, and then, of course, the whole buying process from attorneys to accountants to the mortgage company. And it was Spark Financial who ended up put this all together. And it was a phenomenal experience because I've never seen anything like it. I really thought I was going to like a movie launch or something the other. They had these like girls dressed up in the coolest kind of like clubland pilot outfits with briefcases and maps, and there was a person there giving out champagne that was made from this kind of like really cool dress contraption thing that was really interesting. It's a crazy sold out event, and it was really excited to see how many people were actually interested in investing in Florida. You know, it seems counterintuitive because, you know, when you consider that prices are on the rise, mortgages on the rise, and, you know, would now be a good time to invest, especially when you're coming from other countries and maybe the currency exchange is not even lucrative for you to take advantage of that?
The quick answer is yes, and we'll get into why. You know what?
I can't wait. Just tell me, John. You're here, so you might as well just tell me what's going on with regards to that as well, too.
So, yeah, okay. So it's true that interest rates have gone up, but that means just the scope of opportunities have changed, not necessarily that the opportunity has changed. Now, someone in Canada, like look from where I'm from in Ontario, there's a lot of landlord rules, and it's not as landlord friendly. Now here, there's still opportunity where there's landlord friendly. There's more investment opportunity, and when you're coming from somewhere else where the price point is actually going to be a little bit higher, even after the the dollar conversion, long term it is a better investment. Long term, it is if you're going on the buy and hold opportunity. If you're going on buy and hold, then you're always playing the long-term game. Landlord-friendly opportunity, cash-flowing opportunity, still available in Florida. And this is a tourist destination where many people want to go. And then there's also opportunities with short-term rentals where there's better rules for that, right? There's not as much restrictions as some other places. Now, that doesn't mean there's not other places that don't have restrictions as well. But Florida seems to be pro-business, pro-real estate. And that brings more opportunities and exposure, and more opportunities to get investors, because investors will want to pull their money to come here.
And, you know, it's funny you say that, because I was going to this event and they kept telling me that, you know, they sold 200 tickets and they got another phone call. We're up to 300, 400, 500. They're like, guys, we can't accommodate any more people. We're at full capacity, standing room only, 700 people in attendance. And I'm like, what on earth are you guys doing? You know, I've been doing these kind of events and doing what I call a dog and pony show, you know, hauling up bags and suitcases of brochures. Thank God we don't have to do that anymore, because you can just print out all this digital material now and present it on a QR code or whatever the case may be. And it was incredible to see so many people come out and, echoing the exact same sentiments that you were saying. It was really interesting to see that the real advantage here is, number one, cash flow. Number two, passive income. Number three, lifestyle assets, something that you can actually use with your family, take advantage of, enjoy our beautiful weather all the time. And then in addition to that, you are also seeing a property that can appreciate. You are also looking at properties that are a lot more inexpensive than many other places within the country, that is within the United States, and many other countries in the world. So for a lot of people, in spite of where the interest rate is, it's a no-brainer. And that's the part that I liked about presenting something that's so dear to me and being able to become, quote unquote, the Orlando expert, if you may, on presenting many of these investment opportunities that exist, not only for investors domestically, but internationally as well, too. Justin, I think we have a call.
So this is Ethan. Ethan, are you there?
I'm here. Good morning.
Hi, Ethan. How are you? So Ethan Foote is the main point of contact over at Spark Financial, the amazing company that put together this incredible event that I was telling you about that we attended. Ethan covered the portion about mortgages, which really kind of blew away a lot of the people that were in attendance. Ethan, thanks for coming on to the show. I actually had a couple of questions to ask you, and I just wanted to kind of point out a couple of things that may be on a lot of people's minds this week in particular. So,
sure.
Although, we've been talking about the advantages of buying in Florida and how it's attractive not only for a lot of domestic investors that are looking from other places such as California, New York, Chicago, because we've seen a big influx of people coming from there. We've also seen a lot of international buyers wanting to jump into our market. And something's happened in the mortgage industry that really kind of made me scratch my head and think, what on earth is going on? Because it's counterintuitive to any kind of logic. For the first time, we've actually seen buyers in the hottest time to buy, which is the spring home buying market, not only face inventory woes, which is a low inventory that is available to them. Not only are they seeing interest rates that have been higher than what they've experienced historically, or at least within the last few years, but now for the first time ever, listen to this, listeners, if you actually have a credit score of 680 to 779, you're actually being penalized, meaning you're actually having to pay more than someone that has a credit score of 679 or lower. Ethan, can you explain to us what on earth is that all about?
Sure, I'll be glad to. And, the first thing that comes to mind is just a big sigh as far as, geez, why this, why now? Especially with mortgage interest rates having moved up like they have over the past couple of years, and especially within the last 12 months. So the Federal Housing and Financing Agency that oversees Fannie Mae and Freddie Mac, who purchases conventional mortgages, has devised a new pricing framework aimed directly at mortgage rates called loan-level pricing adjustments. Then based on your credit score, down payment, debt-to-income ratio, or if you're a first-time home buyer, this new framework will directly impact what your mortgage interest rate will be. And a little bit of context is that the Biden administration has said that it wanted to make housing for first-time home buyers more affordable. And, many of us, like yourself, me, and the mortgage and real estate industry, were under the impression that it would be through down payment assistance programs funded by penalties that large banks pay to the U.S. government for discriminatory and unethical banking practices. So an example of how this change has impacted rates is this. Let's just say borrower A has a 650 credit score, a 10% down payment, and a loan amount of $360,000. Then we have borrower B with a 720 credit score, 10% down payment, and the same loan amount of $360,000. So borrower A will have a rate of 7% with a monthly payment of around $2,395. Then borrower B, with that better credit score, will have a rate of 7.875 with a monthly payment of $2,610. So that's a $215 monthly difference that borrower B is paying simply for having a better credit profile than borrower A. However, FHFA, Fannie Mae, Freddie Mac, however they frame it, It's essentially a subsidy to lower credit profile borrowers, with the cost burden going to higher credit profile borrowers. And I'll just say that on the bright side, there are so many loan officers, realtors, and the Mortgage Bankers Association. They're calling for congressional action to reverse the policy, with hopes to encourage seasoned home buyers back into the market, especially this time of the year being a spring market.
You know what, Ethan? It's almost making me not want to have to pay a couple of credit cards so I can ruin my credit so that I can get an advantage over. I mean, this doesn't make any sense. Anyways, I got another one for you. So the Fed increased the rate one more time. I mean, can they just stop anytime soon? By another 25 basis points.
Well, we're hoping so. And great question. And my opinion on this is no. The reason the interest rates weren't impacted in the recent May announcement of a quarterly increase is because the head of the Federal Reserve, Jerome Powell, had alluded to slowing down rates and increases back in March, since the Consumer Price Index, which measures inflation and unemployment numbers, were beginning to move in a favorable direction. So after this information Mr. Powell gave from the March meeting, mortgage banks and lenders had considered that there would likely be another quarter increase in rates. So they had already factored this into April and May's rates. And the thought is that for Q3 and Q4, we may actually begin to see some downtick as far as interest rates are concerned, which equates to lower mortgage payments.
You know what? You just answered the second question that I was going to ask you as well, too. So you definitely, in the short run, don't see these increases as actually increasing the mortgage interest rate in the short run and actually seeing it decrease more so towards the end of the year? Is that what I'm hearing you say?
Sure. So provided that inflation rates can get down to, say, 2% and unemployment rates get down to about 4.5%, then the likelihood that rates would increase is pretty low. The Federal Reserve uses those numbers to determine if they want to increase rates to curb inflation and spending habits.
So, okay, this brings us to maybe a little bit of a controversial question. We were talking, when we were together last week, and as we've begun to see, like I said, mortgage interest rates are on the rise. But at the same time, those who were able to take advantage of purchasing a property 2 years ago or even before that are now sitting pretty with a lot of equity in their home. And what's happening is it's actually forced a lot of landlords to consider not selling their home and actually turn their properties into rentals and actually them becoming a landlord so that they don't forfeit that 3% interest rate. But for those who are looking to leverage, for those who are looking to expand their portfolio, do you think now, even at higher interest rates, would be a good time to take advantage of using that home equity line of credit that one is sitting on?
I absolutely do, Dawood. And, what I just mentioned a moment ago on rates likely not increasing this year, it's still a great time for home buyers or homeowners to use their equity in their property to invest in additional real estate, consolidate debt, or invest in other ventures. And with the amount of equity appreciation that's occurred over the past 3 to 5 years, where values are steady in certain parts of the country, and especially here in Florida, and with single-digit interest rates, it's still a great time to make that equity work for you and other investments.
You heard it from the pro. That's Ethan Foote from Spark Financial. He's going to be a regular guest on our show, giving you all of these just juicy gems when it comes to the mortgage industry and on all things happening relating to financing and where our housing market is going. Of course, if you want to connect with me and you have a real estate question, please visit RealSenseNow.com or just catch me on any one of my social media outlets. That's Facebook, Instagram, or LinkedIn by simply typing in my name. That's Dawood, Dawood. Bedrosian is my last name, Bedrosian. Or just call us or text us live, 321-339-1055. Remember, whenever the real estate market, whether it goes up or not, it always trends upwardly over time. Real estate should always be looked at on a longer term horizon. Think 10 years or more. And of course, stay tuned for my next segment where I continue to interview my good friend, John Papaloni, where we get into the nitty-gritty of investing in this real estate economy. Whether we're in a recession or not, we're just going to talk about all these cool strategies and opportunities that exist in our current market. Catch you after the break. back. The best hour of the week, the best hour you're going to be tuning into, RealSense Now, with your host, Dawood Bedrosian. I love doing this show because I feel like it's my way of giving back and sharing the experiences, what's trending in the market, what's been going on, and really be able to share it with you guys. It's a bird's eye view on the market, the real estate market, the economy, and really kind of give you a sense of what's going on. I think that's the reason why we called it RealSense Now. I'm joined today with John Papaloni, friend from Canada, visiting to sunny Florida. He's a real estate investor, a real estate advisor, a fellow podcaster, an all-around real estate maven. The guy's a wealth of information, and I'm happy he's here with us, joining us in sunny Orlando for the very first time. John, what brings you to my neck of the woods?
Well, to start off with, you told me you were buying lunch, so that excited me. And then I thought, hey,
how did I get suckered into doing this? This guy shows up for the first time and he wants lunch all of a sudden. Don't worry, I got you. I'm going to take you to some of my favorite places in town. Believe me, you're going to be raving about it and telling all your friends about it. I'm sure when you come down next time, you're going to be like, hey, I'm going to take you to Dawood's favorite place as well, too.
Exactly. See, now because people tell me that I owe them lunch. Apparently, I asked for lunch too many times.
Don't worry
so
about it.
I said,
It'll
when you come to Orlando,
it'll be my honor.
I'll show you. And they're going, where are we going to go? I go, I don't know. After Dawood takes me, I'll let you know.
Listen, my colleagues and some of my investor friends always make fun of me. They say, if you only knew as much as you know about restaurants and cool places to go, as much as you knew about real estate, maybe we can all make some money over here as well too. So I feel like I'm the best of both worlds. In many cases, I think, some of my suggestions may be better than even Google reviews as well too. So I'm definitely going to take you to the right places so that you can have a memorable experience over here. But seriously, what brings you to my neck of the woods, and what makes investing in Florida, especially at this point in time, so attractive to you and your clients that you actually flew down here to discover the opportunities that exist here?
Absolutely. Again, it goes back to what I said earlier about opportunities, right? The opportunities here exist, and it's a place that, like right now, the trend is snowbirds like to come down, and whenever it from a cold economy, you want to leave, and there's an opportunity where people can go and bring their family during times like when it's cold or when they want to get away, and they have the opportunity to make money when they're not here by even short-term rentals, because short-term rentals is a good opportunity here, and it's a way to make big money, and versus the 12-month month-to-month rent, which tends to be lower. I'm not saying you can't make money with the month-to-month rents, but you can. But you can make better money with the short-term rentals, and you have the ability to use the place when you need it without having to find something. So it's almost like your own timeshare, but you actually own it instead. So and that actually helps you with the interest rates today as well, because the increased income with the short-term rentals kind of outdoes the interest rate increases and gives you more cash flow, which is what I'm about in terms of investment purposes.
And it's funny because, when you look at other markets, whether you're looking at the Miami market, the New York market, the Chicago market, the California markets, whether it's San Francisco, or even looking at international markets, London, Hong Kong, Tokyo, Toronto, for example. What's the average price of a single-family home in your market?
So the average price of a single-family home in my market, we're going to use Etobicoke, and I'm going to use that because it's central between downtown and further west, so it's kind of in the middle. And that average price is really about $1,080,000 right now. It was a lot higher before the interest rate increase, but it's still kind of ridiculous high, and it's a high-priced item, and it brings a negative cash flow. It no longer is cash flow positive.
So do you know what the average price in our Central Florida market is? About $421,000.
Yeah, see, look at the difference there.
So
even if you do the
conversion,
that's only going to be like roughly $680,000-$700,000, roughly.
Yeah. So it's funny when you talk about all of these things as well too. You tend to hear in different markets people that focus on the attributes of what their markets have to offer. When you talk about a lot of bigger cities where the price points are higher, even though the rents are higher, in many cases, oftentimes people are banking on appreciation, but are treating the cash flow within their asset as net neutral, meaning they're making $0, or negative cash flow, where they're encouraging investors to kick in a few $100 a month or $1,000 a month because there's appreciation in that market. You see, I look at it this way. If I'm going to a buffet, which I often don't go to,
Right.
but if I am going to a buffet, I'm not going for one item. I want it all. I want cash flow. I want passive appreciation. I want to be in an environment where I'm getting passive income. And I want to be in an environment where my ability to rent a property is favorable to me, the owner, the landlord, not tenant favorable.
Right.
In your market, it's near impossible to evict a tenant out of the property because it's such a long process. Am I wrong or am I right?
No, you're right. Especially now with the backlog, if a tenant does not pay you, they can take 10 to 12 months to get them out. And that's assuming that you served them properly. If you serve them the N12 on the wrong day, they can take 10 to 12 months to get to court, and then they're going to say got it on the wrong day, and the process starts over. So now you're almost 2 years of not getting paid.
Welcome to Florida. You can get this done in a month to 2 months if you follow the right rules and procedures, and it's a pretty easier process. Let's put it that way.
Right.
Right.
Now, I'm going to tell you something. And here's what I have a problem with: a negative cash flow. Because what happens is, yeah, sure, the investor could possibly afford it, but you're restricting future opportunities based on debt to service ratio. And what ends up happening is you end up having one property and you're locked. Versus if you have a cash flow positive, it gives you a bigger income, because that income after 2 years is considered towards the next purchase as an income, and which is a bonus, right? So it gives you the ability to expand faster. And on top of that, there's many unpredictable things that happen. Plumbing can go, roofs fall down, and if you don't have anything set aside because you're neutral, as you had said, next thing you know, now you're losing money. And
maybe you can't even afford repairs because they're big ticket items, and you may need to wait it out a little bit longer.
Right, where if you're in cash flow positive, even if it's small, that cash flow over the time, the worst case scenario is the money you made just goes back into the repair and you're still even, but it's still counted as an income towards your mortgage because they don't calculate your expenses on the loan.
And that's why there's so many attractive programs that exist today, such as the DSCR loans that are out there. That's a debt service coverage ratio, where if your property's rental income has been proven to generate positive cash flow, you can essentially go out there and purchase a number of different properties to go out and build your portfolio based on that alone, just with a decent down payment that you'll be putting down based on what the property can generate as well too. A lot of people are talking about waiting out, jumping into the market based on maybe waiting for house prices to decrease or waiting for the mortgage interest rate to fall to lower levels like we've experienced in recent years. But I love what you say about stop playing not to lose and start playing to win.
Yeah, absolutely.
Talk to us about that mindset and the opportunity that exists in our current market.
Look, there's so many people out there playing defense because they're so worried. What if I could lose? I might run out of money, or this might happen. Interest rates might continue to go up, and what will I do? And oh my God, the world is ending, right? And there's a lot of that because growing up, we're told to beware. And reality is, investors have to have a behold mindset. Look at the opportunity. Look what is in front of you. Everybody I know that they told me was going to wait to invest ended up saying, hey, the market's come down. Yes, but when you said you were going to wait, average home prices were $550. The market went up to 1.4, and now they're to $1,080,000, and they're back on the rise. So guess what? If you had jumped in when I had told you to jump in, even after the losses, you would have still been ahead. And if you want, I can give you a live example of what happened to me.
Please go ahead.
I had a home in Grimsby. I had bought it new construction, and I had bought it obviously when there was no house. I had bought the home for $500,000, and at the peak of the market, it hit about $940,000.
Amazing.
But I sold it about 2-3 months ago, and I still got $730 for it. So I'm still ahead, even with the market drop.
Incredible. A lot of people want to jump into the market. I often get asked the same question every time. How's the market? Is now a good time to invest? How's the market? Is now a good time to invest? And everybody wants to invest on their own, and they don't realize that part of the reason why they don't take advantage of it is for the obvious and common reasons. I was sitting down with my mentee yesterday at dinner, and we were having a discussion about investing. And one of the objections that came up was, I really want to do this, and it makes more sense than, for example, purchasing a new car, but I don't have the money to do it. And a lot of people think that they want to invest on their own and not explore the option of partnering up with someone, because 100%, for some strange reason, is better than any smaller percentage that you can share in an investment.
100%.
People need to be looking at alternative sources of getting into this market, in spite of the interest rate, in spite of the price points, because getting into the market, remember, whether the real estate market trends upwardly or trends downwardly, it doesn't matter. If you broaden your horizon and your scope, the real estate market will always trend upwardly over time. It doesn't matter what the cycles look like, the highs, the troughs, the wave continues to move upwardly over time. What are some of your strategies that you have been advising your investors when it comes to investing in what looks like I'm not sure if we're in a recession kind of environment?
I think we're in a recession. I think nobody wants to call it. But that aside, I mean, keeping politics out of this, that aside, I believe that the opportunities are now. And look, let's make it clear. Real estate doubles every 10 years on average. When COVID hit, it actually bumped it up to every 7 years. Now with the clawback, it's back to 10 years on average. And the data will show that. It's not me just rhyming out a number. And with that being said, so whether you buy it today, if you're going to buy and hold and you're willing to wait the 10 years, you're always going to make money. It's appreciation is always available, and that's been history. That's been 50 years of history, and sometimes even longer, and that is always been the case. Now, the opportunity to buy on your own. Look, we'll even use my market at $1,080,000. Well, when you have $1,080,000 and you're putting down 20%, coming up with that $800,000 mortgage is going to be very rough. And even if you do, the appreciation over the 10 years, we'll say. So now your house is $2 million, and based on the double, as we said. So now that sounds great. That's a big appreciation. But what if I told you you can buy a multiplex, and you're going to hear how I'm a fan of multiplexes now. Now, if you get 20 or 30 people, we'll even say 20 people for easy math, and you have the same $200,000, all 20 people, now you got a multiplex with a 48 or 64 unit, and I can even go smaller, even say, let's go to a 12plex with less people, 10 people. That is going to be a bigger purchase. So if 3 million doubles, that becomes 6 million.
Correct.
Right? So now the pie, yes, you're splitting the pie, but if you calculate the math, the pie is actually per investment per person is actually getting more than if you had to finance your own home. Because yes, I said real estate doubles, but I just also said we have a mortgage and you're paying interest on that mortgage. When you sell it, that mortgage gets taken out. You're only splitting the balance of what's available.
And you're getting the income from so many units that are being rented, and
Right.
rents have increased in our market by over 30%.
Exactly.
So definitely encourage people to consider even a duplex, a triplex, a 4-unit, 5-unit, 10-unit property to consider if you didn't want to jump into a lifestyle asset such
Right.
as a short-term
Right.
vacation rental.
And the other thing I was going to bring up here, what you brought up here with the rents, which I love, is I just talked about appreciation. But here's the other aspect. You have that house that doubles. You're collecting one rent. If you have a bungalow or a ranch, whichever, and you have a basement, you got 2 rents at most.
No basements in Florida.
And no basements in Florida. But you see what I'm getting at?
Yeah.
So now you have one rent, we'll
But
say.
that's the advantage of, like, for example, house hacking. Maybe you can have a separate entrance on the side, or
Yeah.
a unit in the back, or whatever the case may
But
be.
the point is, when you get the multiplex, we'll get a 12plex using the 20 people, like I said. So you're getting the appreciation, as I said, plus you're getting 12 rents to cover the bills.
Absolutely.
And by the time that mortgage is shrunk after that 10 years, like every 5 years, we'll say roughly you're paying, I would say on a as an example, I'm going to use a live example. I'm going to use my own. On a $370,000 mortgage, at this interest rate today, after 3 years of payments, you've paid about $17,000 off. So do that times 3, you've paid off $84,000, and then correction, your renters just paid that off.
Absolutely. I love it. So if you want to connect with me, have a real estate question, visit my website, realsensenow.com. Catch me on social media, Facebook, Instagram, LinkedIn. Just type in my name, Dawood Bedrosian. There's a handsome guy with his arms out. That would be me. Just click the follow, like all of our posts, and follow the content that we have. Obviously, join us every Saturday. We're live from 11 to 12 right here on RealSense Now. Stay tuned. I'm going to keep interviewing this maven because he's sharing a lot of gems on our show today. We're back with John Papaloni right here on RealSense Now. We've been talking about how to navigate investing in real estate amidst a looming recession, rising interest rates, and whether now would be the best time to jump in. John, how do you assess the current state of the real estate market?
Very simple. The available jobs, the available opportunities. Where is the industry going? Because you can see what upcoming jobs and upcoming income potential is going to be there, as well as inventory supply, because that's a key factor. You can't buy what's not available. And then the availability of money. So interest rates has a bit of an effect there, but it's also what are the other options in financing.
And I love it because you talk about migration patterns, and there's a lot of people that want to relocate to Florida. There's I think about 1,000 people moving over here on a daily basis. When you're talking about jobs, I think what's helping curb this recession is that we have a strong employment job market. And then in addition to that, when you start to look at inventory, unfortunately, we still have a shortage of inventory. So any which way you slice it, and this is exactly the reason why we've seen an increase in property values in spite of what people believe to be the market slipping and seeing values decrease. We've actually seen the values increase in the Florida market by 9 to 13%. But I want to ask you this question. Are there any specific areas or property types on your visit down here that you believe are either going to be lucrative or more resilient, especially during this unquestionable time?
100%. See, this is why I'm a favor of multifamily. Okay. If you're looking for long-term rentals, where you have a same tenant month over month over month, I think that multifamilies has the potential to be able to carry even any looming recession or downspouts, because that has multiple rents. So even if some people can't pay or have to move, you still have the ability to pay through the other rents, because 100% of people not paying or having problems is close to impossible. But with that being said, if you want something with higher income, more guaranteed return in terms of cash flow, higher cash flow, then short-term rentals and destination points such as Florida, which is where people want to go to.
I say this all the time. 78 million people came to visit Orlando in 2019. They're anticipating 80 million returning visitors and guests to come by 2024. We're definitely seeing our market to be busy. Our theme parks are packed all the time. So what better place to invest in short-term vacation rentals than Orlando, Florida? And can you provide some insights in terms of the potential impact of what a recession would look like on property values and rental rates? Because it seems to be, I guess, counterintuitive to one would expect, especially here in Florida as well, too.
Right. Again, it goes back to supply and demand, right? And right now with the shortage of home, there's more demand than supply. So, and that's why we're not seeing massive drops anywhere, and we're seeing some sort of consistency. So with that being said, there's different, different things that are going to be, a factor here, but I don't see them going down. I see it now as an opportunity. Plus, what goes down will go up. I mean, Dawood, how is your business going?
Listen, this time last year, June of last year, I think doing the radio show affected my mindset and my perspective on what was going on. It was the first time where we started to see the rates increase, and I think a lot of people put the brakes on wanting to purchase or sell a home, and it really slowed down the economy. But I have to tell you, having to do this radio show on a weekly basis, you start reading the articles, you start reading the news, and you start to buy into the fear-mongering that goes on. And I just literally had to pump the brakes. And I come to the perspective of, look, I'm aware about what's happening in the economy. I work and I thrive in what I would like to call an action economy. What do I mean by that? In 2008, when the market crashed, you couldn't wait for people to come here to want to buy properties. So we did something completely different. We went to where the demand was. In that case, there was a lot of international investors that were coming to take advantage of the lower price point homes, the foreclosures, the short sales, and we were visiting places like Canada, Brazil, to bring clients to want to come and invest here. So my philosophy is this. I work and thrive in an action economy. My actions equate my economy. How much money I generate, how much value I add to my clients, and what opportunities exist for them. I'm aware of the interest rate. I'm aware of the shortages in the market. I'm aware of what's going on in the market. The truth of the matter is, it comes down to the fundamentals. What are the fundamentals? In my business, in my world, there's 9 Ds. What are these 9 Ds of moving? Well, if you're a real estate agent and you're working with clients, the first and most important thing that you need to understand is we live in a relational economy, meaning I can approach you halfway across the world based on following your content, listening to your podcast, hearing about you. Your brand is your reputation. But the truth of the matter is, the 9 Ds are the following. At some point in time, there's going to be a diamond. Somebody's going to get married. Somebody is going to need a home. Somebody is going to need to move out of the small home that they're in into a bigger home. After marriage comes diapers, of course. With diapers, maybe the smaller home that you're in is not going to be suitable for your now 1, 2, 3 kids. And we need to get you a larger home, maybe in a different area, maybe in a better school district. Unfortunately, the other D is also what we can't escape from in our life, and that's death, of course. When someone dies, their kids may not want that property that they've inherited, and they now have to sell it. The other D, also unfortunate, is divorce. You have 2 people that have been living together under one roof. Now they have to sell their home and, of course, buy either 2 homes or figure it out for themselves. Sometimes you get a degree, you get a call, you graduate from a master's program, a doctorate program, an undergrad program, and you need to be on the hunt for that next home in that new market. Very important. Then you have, of course, dumpsters. Those that are looking to seek housing outside of their primary residence. It could be what they're doing, renovations, either an improvement, an investment. Either which way, a great opportunity for expanding your portfolio. And then, I hate to bring this up, but there's also downsizing. You downsize because you have, for example, a elderly couple that now wants to retire. They have to sell their big home, and maybe they want to move into a smaller home and now actually buy that second home, snowbird property, or even vacation property. And then there is difficulties. The difficulties that you experience, we've experienced this in 2008. That's a short sale, a foreclosure, maybe not being able to pay for the home. Maybe you have lost your job. Part of the buying and selling process that exists in our market. And then, of course, there's desks. Desks meaning you have to change your job, you have to sell your house and transfer to another location. And then who would have thought the last D, probably that bonus D, the one that nobody seems to think about, but has become even more and more important in our lives, our dogs.
Oh, yes, that's
our
right.
little furry friends that become an integral part of our household. And now that 4-legged friend needs bigger space than the little condo that they're in as well too. And a lot of people are now considering that as being part of the buying decision or the selling decision for their property. Humans will always need to buy and sell real estate. And since we are in the business of real estate, we need to be mindful of all of these factors. I'm always here to help you answer any questions that you may have in the real estate market. Feel free to always connect with me by visiting my website, that's realsensenow.com, or checking me out on any one of my social media platforms. That's Instagram, LinkedIn, or Facebook. Thank you, John, for being a guest on my show, how can people get a hold of you if somebody wanted to reach you?
Absolutely. You can reach me on Instagram with my name at John Papaloni, JohnPapaloni, or you can add .com to that and visit my website.
I love it. Thank you for listening to the show. It's your host, Dawood Bedrosian. You're here live on RealSense Now. Catch us every week from 11 to noon on Florida Man Radio.